Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 189. And it seems that you can't leave a day without something changing at the moment, but we will go through all the macro and economic data and markets data even. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Once again, it's been a very busy 10 days since we last reported. First of all, the news. So, two US courts have declared that Trump's tariffs are unlawful. The US Court of International Trade and the DC District Court. He will almost certainly find a way around this, even if it means going through the usual process of the House and the Senate. But for now, tariffs remain in place until further notice as the president appeals those judgments. The tariffs on steel and aluminium are unaffected, and indeed he has since raised them to 50%. They are legal. Now, without the tariffs in place, the US deficit is forecast to rise from 6 to 7% if the big, beautiful bill passes. Donald Trump has had a busy tweeting period over the last 10 days. He first of all accused China of violating their trade agreement, but then he hailed progress in talks with China and has extended the pause on some Chinese tariffs to August. OPEC Plus met and announced a further increase of 411,000 barrels a day in production in June. That is in addition to their production increases in both April and May of the same amount. So OPEC Plus has accelerated its increases in oil production. Had the UK Defence Review, which involves the UK adding 15 new attack submarines. How will it be funded? Ukraine hit Russian air bases with an audacious drone strike. We have a map. They were all over Russia. Russia has since hit back. There is little sign of a ceasefire in Ukraine. Trump and Musk have fallen out very amusingly and predictably. And finally, the markets continue their recovery, and the S&P 500 closed Friday above 6,000 for the first time since February. On the economic front, the ECB met and cut rates as expected to 2.15%. Rates have halved over the past year, but Christine Lagarde stated that the ECB was towards the end of this cutting cycle, with the interest rates well poised to react to changes in either direction. The OECD downgraded global growth for 2025 and 2026. They downgraded UK growth by 0.1% in 2025 to 1.3% and 2026 by 0.2% to 1%. The growth outlook for the UK still looks very weak. The US growth forecasts for 2025 will reduce to 1.6%, 1.5% in 2026, and they forecast US inflation to rise to 4%. The OECD also warned that the UK debt to GDP level will rise to 104% in 2026, and the Chancellor will need to cut spending and increase taxes to stabilise finances. We have the spring statement on Wednesday. Non-farm payrolls came in slightly hot, but the March and April numbers were both revised lower. It confirms, actually, despite the fact that it was a beat, that the US labour market is slowing. And the ADP numbers came in soft, after which Donald Trump upbraided Jerome Powell for not cutting interest rates and demanded that he cut rates by 1%. The market didn't believe that the Fed would cut rates. In fact, after the strong non-farm payrolls number, they cut the probability of a July rate cut to 16%. And the market is now pricing in 45 basis points of cuts by year end. And Taco, Trump always chickens out, has gone viral. Now, to me, that changes its effectiveness. Donald Trump, when questioned about it in a news conference, did not like the fact that traders were making money out of the Trump always chickens out trade. And that will tend to make him firmer in future negotiations. As a brief aside, I've been listening to a podcast on World War One and the start of World War One. And one of the reasons events spiraled out of control is that after the assassination of Archduke Ferdinand, the Austrians issued an ultimatum to Serbia, and they expected Serbia to back down because twice previously, when the Austrians had made demands on Serbia, the Serbians had backed down. Whereas the Serbians thought, well, we've backed down twice, we can't back down again. Is conducting trade policy and diplomacy by tweet, and it seems to change every day, making this podcast quite difficult to do. But this is where we are. US tariffs change by day. We're back to 15.6% average tariffs. You've seen how much they've changed over the course of the last month. Now, the number of container ships traveling to the US, we thought they were recovering, but they've since slumped to new lows. The tariffs definitely are affecting trade. But Chinese exports have hit a new high despite lower exports to the US. China is finding different avenues for its exports. Nvidia continues to grow, beating forecasts with a revenue rise of 69% despite Trump export restrictions. This is the OECD's downgrades of global growth. They're now expecting global growth of 2.9% in 2025 and 2026. And finally, this is Ukraine's attacks on Russia, which were very clever and hit bases 4,300 kilometers away from the border. Russia has since retaliated. Trump's pledge to get a ceasefire on day one,
I think just on that subject, I was reading that the reason the Russian bombers are out in the open is because it's part of the nuclear anti-proliferation. I can't say the word.
Anti-proliferation.
Thank you. Anti-proliferation. Anti-proliferation.
Proliferation.
Part of the nuclear anti-proliferation treaty, and so they're out in the open for verification purposes by satellite, which of course made them vulnerable. And then Ukraine goes and uses that against them, which must make the Russians incredibly sore.
Yes.
As well.
Yeah, thank you, Richard. I didn't realize that. Oh dear. Now, before we get going, so again, we're going to lead with markets data followed by economic data. Let's briefly go through the CBO, the Congressional Budget Office assessment of the US budget, the Big Beautiful Bill. So they're saying the Big Beautiful Bill Act will increase the fiscal debt by 2.4 trillion over the coming decade. Tax revenues will fall by 3.75 trillion and spending by 1.3 trillion, leaving 10.9 million people without health insurance. Now, the important thing is that tax revenues fall immediately by 3.75 trillion and spending falls later. So it's mainly after Trump has left office by 1.3 trillion. So it front loads the stimulus. However, as tariffs stood in mid-May, that would raise 2.8 trillion over the coming decade. implying that the overall budget would not increase the debt burden if tariffs remain in place. And it's important to realize that this assessment is relative to the 2017 tax cuts expiring. So actually, the the Big Beautiful Bill does not increase the deficit compared to the current status quo, and tariffs would tend to cut the deficit from here. You'll understand it better when I show you the chart in a second. Tariffs would raise inflation by about 0.4% in the coming couple of years and reduce GDP by 0.6%. Elon Musk called the budget bill a disgusting abomination, which would undo all the work of Doge. And reminder, Doge has not achieved very much, and he called on lawmakers to kill it. Now, this is the CBO's estimate of how the House bill would affect the deficit. Now, reminder, this is relative to the 2017 tax cuts expiring. So the current deficit is around 2.1 trillion. These are big numbers. This is really interesting. This is the timeline of how the Big Beautiful Bill would affect the deficit. You can see the tax cuts are front loaded, the spending cuts backloaded, and would have to be instigated by whoever followed Donald Trump. So like in Britain, it's the difficult decisions are delayed. In April, the US collected tariffs at an annualized rate of 255 billion. Now, the CBO estimates that tariffs as they stood would raise 2.8 trillion. Now, of course, things have changed a lot in the last month, and it's difficult for anyone to know how much he will actually be raised by tariffs, whether tariffs will stay in effect, etc., or whether they'll increase as threatened later in the year. Reminder, he's still threatening tariffs of 50% on goods from Europe to go into effect in August. The fundamental problem is that the US budget deficit is now running at around 7% of GDP at a time of low unemployment. So the green line is unemployment. Normally, when we have unemployment at these levels, you'd expect the US historically to be running a budget surplus. What happens when the US economy inevitably slows? That will tend to send the budget deficit towards 10%. Not good for bond yields, I would have thought. Richard, any thoughts?
Yeah, I mean, so as you go through there, sort of trying to describe the current position, Keith, it really emphasizes what a mess it all is, because it's so disparate and so frequently changing. And I was just thinking, when we talk about 255 billion year-to-date cumulative collection, I mean, the collection of the tariffs must be accurate. Collection of these tariffs must be well nigh impossible, because the rates are constantly changing.
Yeah.
If you're actually working in the administration of this thing, it must be virtually impossible to get it right. And I suspect there's a lot of stuff falling through that just simply isn't being done, because it can't be done, because they're trying to chase something that they can't catch up with. The other thing that struck me earlier on, you talked about the OECD saying that the UK needed to raise taxes and cut spending. Now, we're already, is it 45% of GDP is our taxation level? I can't remember exactly the number.
Yeah.
But it's a pretty well-known fact that if tax is greater than between 20 to 30% of GDP, you start to severely damage growth. And the solution to UK's problems is not higher taxes, it's more growth. And so the OECD has sort of come out and recommended a course of action, which is the antithesis of fundamentally, in the long term, sorting out the UK economy, which makes you wonder what the OECD thinks its actual role is, if that's its prescription.
Well, the trouble is, Richard, that the OECD, its prescription is just to get the UK finances in order. Now, in order to do that, it's absolutely right. Your um, point is that government spending is too high, to be compatible with economic growth, the high
Yeah.
taxation levels. Um, but on that front, I would say that, Sweden has even higher taxes and it does all right. So it's a question of, the social contract and incentives. You know,
Yeah. I agree with that. It's probably not as clear cut, but it does strike me. But the UK, one of our big issues is our very low rate of growth, or very low productivity growth, and raising taxes simply
mm,
puts the spending power of the economy into the most inefficient allocator of resources that we can identify, and it is actually it's this constant issue, isn't it? I mean, it's this. In order to be actually effective, politicians need to address the long-term issues. Addressing the long-term issues is difficult and not necessarily
mm,
popular, and they need to be very well explained, and politicians are interested in being re-elected. And we're just
yeah.
going, even though the crisis, I do use the word advisedly, is gradually getting worse, so the spiral is getting tighter, our politicians are still locked into short-term fixes.
Well, the trouble is, Richard, for the UK, I see absolutely no way out of this because ultimately politics is a function of what the populace wants. We've got an aging population who want higher welfare spending, full stop. And I just don't
Yeah.
see any way of reining it in. And so I think that taxes just going to keep on rising as the gerontocracy, as we've described it before, votes for more sweeties for themselves at the expense of working people. I think
Yeah.
that's just inevitable.
And the expense of the younger generation.
Yeah,
Hopefully.
absolutely. Yeah, and so you've seen about 1 million people, young people, not in education, employment, or training, and that is partly a function of very high taxes and the Labour government's increasing emphasis on employment rights, etc., which make it difficult to hire people.
Yeah.
Anyway, to conclude our piece on the one big beautiful bill, if Donald Trump gets the big beautiful bill through, it will be initially stimulatory, but once the effect of tariffs also comes in, if it comes in, it will tend to be contractionary later in his parliament or in subsequent parliaments. On to markets data. Let's start with equities. Richard.
Thanks, Keith. So just looking down I think we'll run down the weekly changes actually, because it's quite a positive week for equity. So FTSE All World up 1.6%, FTSE All Share up 0.7%, Stoxx Europe up 0.4%, S&P 500 up 1.3%, the Russell 2000 up 2%, Nasdaq up 1.7%, Hang Seng up 3.5%, Topics up 0.5%, Bitcoin fell by 3%. The pound rose against the dollar by 0.5% and the euro by 1%. The dollar index correspondingly fell by 0.7% and the VIX was down 11%. So a
Yeah.
solid week for stock markets, and the dollar index basically continuing its decline, now down 8.8% year to date.
Yes, absolutely. And we've got a piece coming up on Section 889,
Oh
which
yes,
is
I know that well, Keith.
yeah, which if it passes would allow the US to put taxes on foreign financial assets, and
Uh,
that would send the dollar quite sharply lower. But what strikes me about this table is VIX. VIX is back down to really complacency levels despite all the macro and political uncertainty. It's like the markets have stopped listening to Trump, basically. They don't think he's actually going to affect anything.
So I wonder whether, and it's impossible to know, I wonder whether what's happening is people assume that at some point the Fed and other central banks are going to restart QE or whatever they care to call it this time around, and the markets will go up correspondingly with the money supply. And I'm wondering if that
Hmm.
fundamentally is what's keeping them high. If AKA the market rises as inflation rises.
Well, the central banks, their mandate is to get inflation to 2%. As long as that is true, then they can do QE. If they can't do QE. It'd be Venezuela if they did QE with inflation above 2%.
Yes, it would be. I mean, in some senses, yes, but of course, inflation can be infinitely manipulated.
Right.
And the last thing central banks want to do is, I believe, I mean, you can never be sure, but I would guess the last thing central banks want to do is to create a sovereign debt crisis in the developed world. So, I mean, at some point, they're going to be between a rock and a hard place. Okay, so here's the FTSE All World Index.
Yeah, the taco
Rapid,
trade has been remarkably successful, actually. That is a
yeah,
big rise.
rapid recovery from mid-April.
Yeah.
And the FTSE All Share Index, basically showing exactly the same shape of chart. The Euro stocks at the same, and the S&P 500. It's interesting, the Euro is up 10% year to date, isn't it? Euro stocks up 10% year to date. It's a
Yeah,
big rise.
it is. If you're a US investor, you get the rise in the euro and the rise in
Yeah,
euro stocks.
yeah, fantastic return. And that's just in like 5 months now, isn't it? 5 months of the year. NASDAQ only up 1% year to date. But again, that same shape chart with the V bottom in April. Russell 2000.
Yeah, still, is that down on the year? Still down on the year?
Still down on the year. The Hang Seng up 20% year to date.
Yeah. They're basically DeepSeek has outweighed, Trump's tariffs. Yes,
Yes.
this is DeepSeek. This is back in September.
Gosh, it wasn't that long ago.
Yeah.
Oh, amazing how the world moves on, isn't it? There's the topics actually unchanged year to date. And Bitcoin, which is up 14% year to date. And there's the pound, so it's on a very steady climb up, as will be the euro.
Yeah. And that's not much to
And
do with the UK or the attractiveness of the UK.
no,
It's all to do with the relative unattractiveness of the US.
yeah, and Trump's avowed intention to weaken the dollar,
Yeah.
and he's doing well. They have the dollar index. That's the VIX.
I mean, that is a really amazing chart. The market now back to complacency levels despite, all the macroeconomic uncertainty.
Yeah, it's unfathomable for people like you and I, Keith.
Well, yeah.
The earnings estimates of the S&P 500 falling, and they've fallen they've fallen what, let's say 5%. So not a massive fall, but a
Yeah.
continuous drop.
No, absolutely. But, equity markets march higher. How do you explain
Yeah,
that?
yeah. And earnings estimates. How does this jibe with the next 12 months earning estimates surpassing prior highs?
Yeah, well, I'm with you, Richard. I don't see quite how those two charts are compatible, because unless you're expecting very rapid growth early, next year.
Yeah, exactly. Yeah. And analysts are cutting Q2 estimates, which again is contradictory with the previous chart. So, so I presume they're doing it on the basis of their concerns about the US economy slowing down generally.
Well, but also tariffs. Tariffs are going to lead to margin compression of a certain extent anyway.
And S&P 500 earnings growth expected to be positive 9 of 11 sectors, with the only sector where it's actually going to be significantly negative is energy.
Yep. Well, that's good news for the world economy. Lower energy prices, very good for growth.
Yeah, we could do with a bit of that, couldn't we? US equities remaining expensive on a comparative basis, historical comparative basis.
Yep.
And this is Warren Buffett in 1999. You have to be wildly optimistic to believe that corporate profits as a percent of GDP can, for any sustained period, hold much above 6%, said Warren. And there
Yeah,
they are at 12% now.
absolutely.
Been above 6% effectively since the around
Yeah,
about 2008. So
amazing.
2004.
Yeah, and that is right at the highs of its historic range. But to be fair, it's been trending upwards. Now, what that says to me is the US big corporates are quasi monopolies.
Yes. Equity risk premium at its lowest level since the GFC. I mean, I know we're like a broken record here. You can't help thinking that something's going to break sometime.
Yeah, but it's, just I completely agree, Richard. We've been totally wrong for years now, but something will turn up. There will be value at some stage.
And the S&P 500 had its best May for 25 years, partly because it had a dreadful April.
Yeah, that's true. But in May and go away was not a good idea this
No.
year round.
Selling may go away at first. You should always be in the market because you never know when it's going to bounce.
Yeah, well,
And the Mag 7 rose nearly 14% in May, up 26% since their April lows.
amazing.
Yeah. And foreign investors, of course, the corollary of US investors doing well in Europe is that foreign investors have been doing badly in US because of the currency uh, depreciation, and foreign investors sold $37 billion of US equities in May, which is a chunk. I wonder if that was probably the Norway Sovereign Wealth Fund getting rid of its Apple shares.
Mm. Well, that
Or
is
a few of
seriously overvalued. When you look
them.
at Apple, it's X growth, but it's still ridiculously valued like a growth company.
And there are 7 trillion in MMFs, money market funds, sitting on the sidelines, which could be allocated to risk assets. I mean, you
Mm.
still think they're sitting on the sidelines because they don't want to allocate to risk assets.
Yeah,
And what they should
massively.
really do is allocate to gold, actually.
More on that
No,
later.
that's just personal opinion, by the way.
Yeah.
Um, Analysts raising their forecast S&P 500 again now that Donald Trump has rolled back the tariffs.
Yeah,
Moving
so
on
they
now.
like us, they timed that terribly. So they were cut them hard, and now the market's bounced back. They've raised them again. Marvelous. We should they get paid for this.
I know. They do, and they should do, Keith.
Yeah.
Incredible. This is NVIDIA. Uh, Sales growth is extraordinary.
Yeah. Now, when we take you through the US data, investment in IT investment added a full 1% to US GDP in Q1. Amazing.
It is, isn't it? I'm actually quite, and this is a serious comment, I'm quite looking forward to having the household robot that does the vacuuming, the dusting, it fills and empties the dishwasher, stuff like that.
Mm,
And I think we're not that far off. I mean, maybe 10 years.
yeah. If it
But
tells
I
you
wouldn't
off
buy
continually, Richard, you could replace the wife.
I wouldn't buy I wouldn't buy one without a kill switch, Keith. By kill switch, I mean I can switch it off.
Yeah.
There's NVIDIA, the fastest growing company in history in terms of equity price.
Yeah. Amazing.
By far. Yeah.
Yeah.
And its quarterly revenue following the same trajectory.
Now, but I remain firmly of the opinion that there's an arms race going on in AI, and NVIDIA is absolutely the beneficiary of that. But I can't see anyone making much money out of it. So, a lot of investment, it's always easy to believe, but when you start having to try and get customers to pay, then the difficulties come.
Yeah. Yeah. I mean,
More on that later, by the way.
and NVIDIA's profit margins, whilst having peaked, they're still very high at 50%.
Yeah. And that was after a 4.5 billion charge due to US export restrictions on its H20 chip. Do you remember last year
Yeah.
when, 2 years ago when its PE ratio was like 200. And I was,
Yeah,
this is absolutely absurd. Well,
yeah,
actually, Simon W was right. The shares have kept marching higher despite the massive PE
yeah.
ratio. Now, we could yet be right, Richard. I still think we will be. But,
Have you still got your short in place, Keith?
I don't do that anymore.
Very sensible. I think shorting is, I mean, yeah,
Yeah,
just it's the it's the opposite side of trading. I can't trade anyway, but
yeah,
shorting is trading on steroids when it comes to losses.
yeah.
For me, despite beating earnings forecasts, Nvidia share price has stopped rising. I mean, at some point, its sustainable future earnings have to meet with its share price, don't they?
Yeah. And then the P ratio comes down.
Yeah,
Although to be fair, the P ratio has come right down, but it'd go
yeah.
when it goes X growth, you'd expect it to come down to what, 20?
And professional investors are currently significantly underweight in tech and overweight in industrials and healthcare. But yeah, and private equity distributions. So we've got a big problem in private equity, haven't we? Basically, they
Yeah.
paid too much money. We borrowed at 0% or 1% or whatever it was, and paid too much money for the companies they bought, and now their interest that they can't borrow. Nobody can borrow at those rates, and so effectively the value of these investments has dropped significantly. And they're looking for mugs to sell them to because the professional investors won't buy them.
Absolutely.
So what we need is for our pension funds in the UK to step in and rescue the PE funds.
Well, I think the what Wall Street, the city does is takes a good idea and takes it way too far. And I think that's absolutely what happened with private equity.
Apparently, Harvard has got about 50% of its portfolio in private equity.
Exactly, which they're now trying to offload.
Yeah.
So there are lots of,
And
I think it's,
I actually have a concern that they will succeed in off in creating, the private equity industry generally will succeed in creating some sort of offload ramp that basically passes the buck to the less well-informed private investor.
yeah, I think higher interest rates totally kill the private equity game of
Yeah,
gearing up the balance sheet and taking
yeah.
out dividends. I mean, and Thames Water is a great example of how the industry just took it way too far. And onto commodities. Thank you, Richard. First of all, a summary. So energy generally up slightly, particularly coal. Coal had a good couple of weeks. Industrial metals mixed. Copper's up. Reminder, most of the commodities are priced in dollars. So as the dollar falls, the dollar price of most commodities goes up. But that doesn't mean that actual price on a when considered for like European consumers has actually gone up. Precious metals, gold up a little bit, but the rest of precious metals shot up. Silver was up 8%. PGM's also really strong. We'll take you through the data. Right. First of all, energy commodities. Well, surprisingly, over the past couple of weeks, oil was up a decent amount. I mean, it's still down on the year, but given OPEC Plus are opening the taps, I was surprised by that. European natural gas prices that had in the previous couple of weeks that had a bit of a rally. Thankfully, that is fading again. Now down over 30% in the year for the UK at least. US natural gas prices resilient, up 10% over the past couple of weeks, up 3.3% year to date. Coal seems to have found a bottom, up 4% over the past couple of weeks, down 16% year to date. Uranium, this little rally has faded. It fell 2% over the past couple of weeks. This is Brent.
Interestingly, the uranium shares are rising again.
Right. They believe. So this is Brent, seems to have found a bottom.
You mean you don't believe, Keith?
um,
Are you declaring yourself as a non-believer?
Well, I just think there's a hell of a lot of uranium. There's a hell of a lot of uranium mines that can be brought back into production. I think the fundamental problem is not the availability of uranium, it's the availability of processed uranium.
Yeah, that's a very good point.
Um, this is WTI. That's actually had a surprising rally. Now the reason for that, I think, is that the rig count is dropping quite quickly now. So over the past 2 weeks, you've had 23 rigs come out of the US market. So
Is that
yeah, lower oil prices are mean that the shale drillers, are cutting back production. Now, so with a lag, that will reduce US oil production in probably about a year's time. Now, currently, US oil production is pretty stable at about 13.4 million barrels a day. That's down the best part of 200,000 barrels a day since the start of the year. But despite that, over the past couple of weeks, we had a big crude build in the US. So the past couple of weeks, the US market has been seriously oversupplied. Now, shale production in the US is forecast to peak in 2027. The supply shock from US shale is over. So it's grown from pretty nothing to 9 million barrels a day over the past
how
decade.
sustainable is it over the long term, Keith? US shale production?
Well, this would suggest that, it's pretty sustainable. It's going to fall by 2.2 million barrels a day over the course of the next 25 years. So plenty out there. And
Mm.
as we've discussed before, the shale revolution is a technology revolution. If they could increase the proportion of the hydrocarbons in place that they can recover, then, it could grow. Small increases in recovery rates would make a huge difference. Now, the amount that oil and gas companies are spending on exploration has collapsed. So, the bottom of the next oil cycle, where is the marginal new barrel going to come from? We talked previously, it could come from shale, but most of the accessible shale is in Russia. And total upstream
Mm.
investment,
But
you know, well down in the
sorry.
last decade. Sorry, Rich.
Yeah, so at what point do you think is the time to begin investing for the next upcycle in the oil market?
Well, frankly, I think I would be doing precisely what I always do, which is wait until the bottom of the next recession when everyone is uber pessimistic. And then when I feel super bullish, I'm going to sit on my hands. And your job, Richard, will be to say, sit on your hands for 3 months, Keith, because your timing is always shit and always too early. And then I will go in. And I've got some price alerts on some
Oh,
oil
have
companies
you?
I want to buy, but they are a lot
You are
lower than they are now.
you are stalking.
I am. But the thing is, it's you have to wait until the bottom of the cycle, and we're nowhere near that.
Yeah.
So this is EU natural gas futures, which that's good news. So the spike earlier in the year has totally unwound and seems stable at around these levels. UK the same. US natural gas futures are firming. Now, reminder, a lot of US natural gas is produced in the Permian as a byproduct of oil production. So as the rigs come out of the Permian, that means lower natural gas production. Hence, US natural gas futures are firming. And of course, they're now exporting a lot of it through LNG. Right, this is coal, seems to have found a bottom. Uranium up from its lows, but
On its
not
way
in
up.
much places. Yes, on its way to the stars. Industrial metals, Richard.
Okay, so just looking down the year to date, there's been some quite strong rises in industrial metals and some quite big drops. So aluminium pretty much unchanged, cobalt up nearly 40% year to date, and copper up 21%. Iron ore conversely down 7%, and lithium down 20%. Neodymium up 12%, and nickel pretty much unchanged. And tin up 12%, zinc down 11%. So it's interesting. Cobalt and lithium both used in lithium batteries, and they've gone in opposite directions.
Yeah. Well, cobalt, the price was very
And
depressed. And frankly, this is another thing I got totally wrong because I was talking about how there was this wall of cobalt coming out of the DRC as a byproduct of copper production. And that was going
yeah,
to continue for years. But cobalt, which is a very illiquid market, has rallied strongly. And the thing
yeah,
I'd highlight here is that iron ore, that shows continued weakness in Chinese
yeah.
construction.
I think the Chinese construction industry is completely destroyed,
Yes.
um,
Yeah, I agree.
and I don't know how they fix it.
Well,
I really don't.
the thing is, with declining demographics, they don't need, they're built more than enough flats, frankly. You know, I
Yeah,
think the Chinese construction continually slows from here.
they've got
Um,
vast quantities of empty cities. Empty
yeah,
cities of blocks of flats. Copper, I think, is interesting. The
yeah,
copper, and that presumably is due to electrification, which is what we've talked about on a number of occasions over the last couple of years. And I think copper is probably reflecting that element of industrial demand.
yeah. I think copper, goes in the next 20 years, continually goes higher because we're electrifying everything.
Okay, so some charts is aluminium, cobalt, copper, iron ore, lithium, neodymium, nickel, tin, zinc. Precious metals. So year to date, gold up 26%, silver 25%, platinum up 36%, rhodium 27%, and palladium 20%. So all the PGMs doing very well.
Mm,
And in the last week, as Keith said, silver was up 8%. And his gold, which is pretty much unchanged on the week. I would say that's probably a flag, and it's going to rise from this point. This is Bank of England gold holdings. I mean, there was a lot of gold shipped out to the US, wasn't there, earlier on in the year,
yeah.
and this is a reflection of that. And Bank of England, a lot of Bank of England gold holdings is held on the behalf of
Mm,
foreign governments, and I think
yes.
there's a lot of repatriation going on because foreign governments are starting to lose faith in other foreign governments.
Yeah.
So US gold exports to Switzerland, and that's probably a lot of that is for refining, and some of it may be for storage.
Mm,
But again, is it due to worries about confiscation,
yeah.
which
So
sits
you're
in
right.
Switzerland?
Everyone's just bringing their gold home. The
Yeah,
confidence in other countries, uncertainty.
I think the confiscation of assets, whatever your view of it, from Russia by both the EU and the US has really made people want to be very, very cautious about having significant quantities of assets that are sovereign states having significant portions of assets
Mm,
that are confiscable by other foreign states. Central banks have actually been accumulating more gold than they've been letting on. Well, I can't say that surprises me terribly. The interesting thing is that while central banks have been accumulating quite large quantities of gold for the last 4 years or so, the consumer, the individual, has been doing the opposite and has been divesting themselves of gold.
well, the thing is, when there is a limit to the price of gold that consumers will pay, and also, it is a store of value, and particularly lower paid workers in the West generally, but in particular in the US, if gold hits a certain price, you're tempted to take your gold necklace down to the smelters.
Yeah, completely. Whether it's a sensible financial decision or not, this is silver, which is obviously benefiting from the rise in the price of gold. And so corollary of what we're just talking about is that whereas an ounce of gold is hugely expensive, if people want a little bit of exposure to precious metal markets, buying a couple of ounces of silver will cost
Mm.
you 60 or 70 pounds in sterling. So,
Yeah.
which is much more affordable. There's platinum. I mean, something has goosed platinum, hasn't it? I don't know what it is.
Mm. No, I don't know what it is. I'll do some digging for next week. But what is certainly true is that platinum and the other PGMs are used in mainly in catalytic converters, and
Yeah.
there's there's just no substitute for diesel. So that has become increasingly clear that electric trucks are just a nonsense unless you get solid state batteries, Richard, which could be transformative. But you know we'll not
Not
hold our
not yet.
breath, frankly. Yeah,
Yeah. And even if you do, let's say in 10 years' time, there's a solid state battery that solves all these range issues and so forth, and for bigger vehicles. It's going to take 25 years for that to
yeah,
permeate the market to a sufficient extent that diesel would effectively become obsolete. And so catalytic converters are going to be required for probably the next 50 years, even in that scenario.
yeah. Okay, thank you, Richard. On to rates. And this is the UK yield curve. And notice the market is not really expecting the UK to be cutting rates much below 3.75%. It's currently at 4.25%. I think that's wrong. Eventually, the UK will get inflation under control, and the Bank of England will cut rates because we've got forecast growth of like 1% in 2026. And so the UK is going to have to stimulate the economy and long-term investment. But the market has lost faith in the UK government and its fiscal balance and is charging an enormous premium to lend the UK over 20 or 30 years. This is the
I think the
US.
problem,
Oh,
yeah, I think the problem is that the markets generally are beginning to lose faith in the ability of governments to control their deficits.
yeah,
Until faith is restored, that will lead to a continuing rise in long-term interest rates,
yeah. And in the
of
case of
which,
Japan, I just don't think they can. I just fail to see any way out of it, really.
yeah,
In
yeah,
the UK, we have the same issue the US does, that every government comes in and says, "Oh, we're going to have get the fiscal balance in order in 3 years' time," but in the meantime, we're going to spend some money.
yeah. And we're going to raise taxes, which will
Yeah.
slow economic growth. And we're going to do actually the opposite to what should be done.
Well, on raising taxes, I mean, one of the really depressing pieces of data we reported last weekly was the PSBR in April, which, despite the
Yeah.
rises in national insurance, which raised up from the top of my head 5.6 billion, we actually increased spending by 6.6. So the PSBR rose. So we raised taxes, but not enough because we keep on increasing our spending.
I mean, it reminds me of a small business trying to project its cash flow forecast. And have some
Mm,
experience in working in small businesses for many years. And typically, small businesses always overestimate their income and underestimate their expenditure. Not
yes.
deliberately, it's just that sort of optimistic nature. And the UK government is doing exactly the same thing continually. And it's like the rose-tinted spectacle syndrome of politicians.
Yeah,
Uh,
absolutely.
and it means that actually they make policy errors because this is a policy error to think that you can fix something by doing this, and actually you can't fix it by doing that. And Rachel Reeves has made she's made actually, in my view, several massive policy errors.
Yeah. So this is UK and US, the yield on index-linked 10-year bonds. and you can see they have gone right back to pre-GFC levels. Now, growth, and certainly in the UK, is structurally low. And if we can convince markets that we are fiscally responsible, I expect that to start drifting down again. But, that requires markets to regain confidence. Now, this is not the rise in bond yields is not because of changes in expectations for inflation. So these are long to 10-year inflation rates, break-even inflation rates. And in the case of the UK, you'll see it's been pretty stable for years at around, was that 3.2%, 3.3%. Now, reminder, in the UK, index-linked gilts are linked to RPI, which tends to be about 75 basis points higher than CPIH. And on the February 2030, index-linked bonds changed to being indexed to CPIH, at which point you'd expect the pink line, to come down by 75 basis points towards the blue line. Now, the fact that it's very puzzling that 10-year bonds, half of which, so over the next 10 years, half of your yield will be linked to RPI and half to CPIH. And so the pink line should have been starting to come down towards the blue line, but it hasn't. UK index-linked gilts have not yet started to price in the move to CPIH, which has been well flagged. We've been taught the Debt Management Office have warned about this. They've for 10 years ago now, isn't it? So you'd expect the markets to be starting to arbitrage the difference, but they haven't. But bottom line, inflation expectations well anchored. And this is not just a UK and US phenomenon. Everyone's bond yields have risen. Look at Japan. 10-year Japanese bond
I'm
yields.
minded of a
Go on.
I'm minded of a conversation. I think I might have referred to it before, Keith. I had with a mutual friend of ours who's works in the pension industry, and I asked him a few years ago if he was worried about the UK government debt requirement, and he said, "I'm not worried about it until institutions no longer want to buy it."
Yeah.
And I just think we are rapidly heading towards that situation where institutions are thinking, do we really want to own this stuff?
Well, I think a lot depends on inflation. If inflation falls back below 2% and you're getting 5%, I think you do. But, if
There's a
inflation
default
is
risk there.
4%. Yeah, but the thing is, Richard, the UK will never default on its debts. The way it would default is by inflating it away.
Yeah, so but that is a default. Effectively, that's a default risk by another name, Keith, isn't it? And and the risk is that that default occurs by, and it will, as you say, it'll occur by inflation, which means that although inflation expectations may be low, they may not necessarily be actually reflective of what's likely to happen, because most people you ask about inflation, they think, well, is my milk going to go up in Sainsbury's? They
Mm.
don't think, is the government going to have to create inflation so that the sovereign debt remains serviceable?
Well, the thing is, Richard, actually, my daughter asked me yesterday about why we couldn't return to the gold standard. And I was explaining to her we couldn't return to the gold standard because eventually the gold standard requires governments to choose between protecting the value of the currency or protecting the economy. So, and I said the government will always choose to protect the economy over the value of the currency. And when it comes to, the choice that will eventually have to be made between, inflation or the economy, then I think that the government will try to choose the economy, but the Bank of England will be, if it maintains its independence, will be raising interest rates hard, which will force an economic slowdown and therefore reduce inflation. So to me, as long as the Bank of England retains an independent mandate, then inflation should stay under control, and the government will then be forced to choose to protect the value of the currency. That is the way the world is set up at the moment. Independent central banks mean that it's not that we have a hard currency, but in that its value erodes by 2% minimum a year, but it ain't going to erode by 15% a year.
I mean, I think this is a conversation that can go on for a number of hours, Keith, and it's a really interesting sort of subject. But I'm going to can I contradict myself here? Is that all right? Because
Absolutely. Yeah, the version B may well be right. If only
if
I'd
they
contradicted myself on the bond trade,
if central banks, independent central banks, work properly, then they are actually a foil for incompetent politicians. And a lot of my dislike of so-called independent central banks recently is that they have behaved, in my view, stupidly.
Yeah.
And if the independent central banks can actually behave sensibly, then and not get involved in things they shouldn't get involved in, and sit and have their eye simply on trying to maintain stability, then I think we will. They can potentially be a force for good. I think the jury's out on that. I think
Well,
what they did.
as we are contradicting ourselves, let me contradict myself, Richard, in that my assumption in what I previously said was that central banks were primarily concerned with inflation, but actually, your point, they're not. You look at the Bank of Japan, it holds 52% of the government debt, and interest rates in Japan are 0.5% when inflation's at 3.5%. Now, what's it doing? It is not protecting the value of the yen or the currency. Its real yields are minus 3%.
Yeah.
So your point, central banks have to be acting in a way to protect the economy, to protect the currency, rather than stimulate the economy at whatever cost.
Yes. Yeah, I think that's absolutely right. They've lost their way, and Mark Carney's impetus, which I think is now losing impetus, to try and make central banks have some responsibility for climate change and regulating business.
Yeah.
I mean, utter nonsense, completely way off beam.
Now, growth forecasts are coming down continually, even in the US, or actually particularly in the US. But government debt levels are just out of control for a peacetime period. So what's driving the yields higher is concerns about, frankly, government solvency and who is going to be buying all this debt. But having said all that, where the doomsayers saying that US is not going to find buyers for its debt, it is. Either the bid cover ratio in the 10-year is very good. It's at 2.6 times.
There's a lot of people who say that the US reserve currency is about to collapse and so forth. And it's nonsense.
Yeah.
What is happening slowly is that US reserve currency it's going to lose its importance, and secondary reserve currencies will arise to compete with it. That's what's happening, and that's what I think is going to continue to happen. The US monetary system is not going to collapse.
No, I agree with that. The bid cover ratio is 2.6, which is very good by, average, slightly above average for the last 10 years. And that's 8.9% is taken by the primary dealers, which is low. So most of it's going to professional investors rather than, landing with the banks. Now, and the global sell-off, look at this. They've moved, this is Japan and the US, 10-year. They're moving in lockstep. So the rise in Japanese bond yields is not idiosyncratic. It is part of a global bond sell-off.
And interestingly, we've got this global bond sell-off with interest rates rising, but also we've got precious metals rising.
Yes, exactly. It shows the fears of the stability of the entire global financial system.
Yeah.
And the Bank of Japan is committed to QT despite rising yields, so forcing yields higher, selling, the bonds into a falling market. Now this is interesting. So the Fed has been quietly buying the 10-year. Interesting. So it's meant to be doing QT at a rate of 5 billion a month, but on Tuesday last week, bought 10 billion of the 10-year. So is that QE on the
Bit,
quiet?
bit of yield curve control, Keith.
Well, it's only yield curve control if they're selling T-bills to keep
Well,
their balance sheet the same, which they could well be
what
doing.
wouldn't this be yield curve control if it's keeping 10-year rates lower?
Well, it is yield curve control, but yield curve control implies that the Fed balance sheet is not growing. That what they're doing is, Operation Twist, which they did on Greenspan, where you keep the balance
Yeah.
sheet the same, but you sell short-term assets and buy long-term assets to kind of flatten the yield curve. QE is when you just buy bonds and increase your balance sheet.
Okay. I'm with you.
Now, the Japanese 30-year yield is similar to the German yield, but Japan has a debt GDP ratio of 240% versus Germany's 60. If this chart were to hold, then the the correct price of the Japanese 30 is somewhere above 6%.
More like 15, I would suggest, Keith.
Yeah. So watch this space. What happens from here? If Japanese bond yields, long-term bond yields normalize and set by the market, they could go a lot higher. And I don't think markets would enjoy that very much. No, certainly not Japanese ones. So this is the UK 2-year. It's sort of stabilized about 4%. So market is expecting the average UK interest rate to be about 4% over the next 2 years. Reminder, currently at 4.25%. 10-year, 4.65%. That is a lot. But it's been pretty stable over the last 6 months. The 30-year, though, has not been stable. That still looks like a rising channel to me.
Yeah, I would agree.
US 10-year, 4.5%. German 10-year. You'll notice that the ECB cut rates had no effect on the 10-year. France, Italy. Italy, amazing. Italian economy doing okay. Italian bond yields coming down. Notice that German 10 years, they're not coming down. So the market has more confidence in the direction of Italian fiscal balance than it does of German one. Greece 3.3. So on to this week's economic data. So again, we'll try and get through this quite quickly. Quick summary. UK stagflation, EU stagnation. EU inflation now back down under 2%. US fine, but actually interesting. I think it is definitely slowing. We'll take you through the data. China stagnation. UK, Richard.
Thanks, Keith. So we've got the defence review, the public spending review is settlement's is published tomorrow on Wednesday, I think, isn't it, actually, Keith?
Yeah.
It's all been finalised. Defence review is stipulating that defence spending will rise to 3% of GDP by next Parliament, but we don't actually have a sort of growth rate for that to get to that 3%. And Donald Trump wants it to be 5%, so goodness knows how we get there. 12 attack submarines, 15 billion for sovereign nuclear warhead program, 6 new munitions factories, presumably all UK based, and partial reversal of cuts in the winter fuel allowance this Parliament to end possibly to end the child benefit cap at 2 children. So a lot of additional spending being committed, plus some other. I think today they're going to increase police spending by overinflation, and the NHS is getting a bit of a boost as well. Again, so how's it going to be funded?
Well, absolutely. How's it going to be funded? Question mark.
Tax increases. Well, so then moving on to some data, the UK services PMI was up against expectations, and 51, yeah.
So actually, this is the second, final revision, and changes the trajectory quite a lot, actually, 50.2 to 50.9. Now, medium term, you'd say still a downward trajectory, but not as bad as it was.
And then the composite PMI at 50, sort of basically fairly stable.
Well, that's a big change. Previously, first iteration, 49.4, revised up to 50.3, i.e. back into expansion. But again, that's not a great number. UK economy not doing well.
I think that's right. I mean, the projections are roughly 1% growth of GDP, aren't they? Which I actually think is within the bounds of error. So the nationwide house price month on month is at 0.5% up in May and 3.5% year on year. So quite a lot higher than expectations. The house prices rising again, presumably continuing to reflect the shortage of. I noticed that the number of planning approvals for housing in the UK has dropped to another low.
I know.
Despite the government's wish, intention, etc., to increase the number of dwellings being built.
So, did you know, Richard, that there's something called mineral tax? Anything that contains minerals, they have to pay tax. So I was shooting at Bisley and this weekend, as you know, and they for every bullet you have to pay a mineral tax. And the instructor was saying that when you build a house, there's 25 grand tax on each new build house, and then there's mineral tax on every tile, every brick, cement, everything. So a lot of the cost of building a new house is taxes.
I had no idea.
Yeah.
No idea. And this is tax on the extractor, presumably, paid by the mineral extractor.
That's right. Yeah.
I mean, the government, they've got their finger in every single pie, haven't they? No wonder, I think no wonder the economy is such a mess with this sort of gross interference by the government in activity. It's extraordinary, Anyway, don't get me started moment.
But anyway, look, so last chart was the nationwide. It's saying house prices went up in May. Halifax saying they went down,
Okay, there we are then. So we've got a bit of inconsistency there.
Yeah.
Bank of England consumer credit. Consumer credit was better than expected. I mean, it's at a sort of reasonably standard level, I think you can say.
Mm.
And net mortgage lending was down, which means more people are paying off their mortgages than are taking them out, which is,
Yeah. That's
of
so
course, there was an enormous spike, wasn't there, with the people trying to get inside the stamp duty increase. So that probably is just a
exactly.
reflection of that.
Yeah, and so the nationwide and Halifax house prices we reported were for April. Let's see what happens in May.
Yeah. And net consumer lending was, we should presume, was significantly down on April, on March, which presumably is the same.
Yeah, yeah. So it's the net consumer lending is the sum of consumer lending and mortgages.
The CBI survey on distributive trades -27 in May, which really isn't good.
No,
And the UK car production, I mean, you can see, can't you, that chart shows quite a nice long-term downtrend with a few upward fluctuations.
yeah,
But it smooths out the monthly changes, which can be quite dramatic.
yeah, but it's not good, is it? You know, just steadily
No.
declining UK car
Yeah.
production.
And the economic surprise index. So after all that gloomy news, we've got actually positive economic surprises from Citigroup. Well, that's a surprise. Sorry, it's such an old joke. Indeed, job postings index 78.2, fairly flat really at the moment.
Yeah, well, it's
I mean,
still in declining, but you know, it's like the rate of decline is slowing.
yeah.
But we've got 20%, more than 20% fewer job openings than pre-pandemic. Trueflation. Right. This is last week. So inflation at 4%, but inflation fading. This is this week. Inflation at 3.5% and rising. Right, I give up.
They need to not.
Yeah, we're
They have to
stopping.
stop interfering with that. They have
Yeah,
to stop interfering with their sequence. You know, the data is what it is as it comes in that week.
yeah,
And it's constant, you know, it's not trueflation anymore. It's something different.
yeah. I give up. We're
It becomes
stopping reporting
meaningless.
it. Yeah,
Yeah.
I tried to include it. It's useless.
So UK financial conditions continue to tighten, and mostly because interest rates on borrowings are continuing to rise. With so the interest rates being charged doesn't necessarily reflect the official interest rate.
Well, it's the mortgages, you know, when they reset, they're resetting to higher rates. Whereas the interest you're getting in the bank is now coming down.
Okay, fair comment. They're still resetting to higher rates because
Yeah.
of they're coming off fixed rates.
Yeah.
Yeah.
And people who are on, you know, refinanced last year, they're still on higher rates.
Yeah.
So
So the Lloyd's Business Group Business Confidence Index is high and rising, which is quite interesting.
yeah.
And
Now
much
yeah,
bit different to the other confidence indicators shown there.
absolutely. Really interesting. I've never come across it before, but it's got a totally different shape of graph to the PMIs, etc. we normally report.
And April permanent places and temporary billings indices still negative, but possibly rising,
Yeah.
becoming less negative. Been negative for a long time, mind you.
Mm.
Rachel Reeves threatening to cut 50,000 civil servants from bloated civil service. I mean, I think a sort of a general point where the civil service should be settling out at is like 400,000, isn't it? Which would be a bit more efficient than back in 2015. I think that the completely unjustifiable increase in the civil service by what's that, 40% or something
Yeah.
since 30% since 2016. You know, it's just, and this is under a Conservative government
I know.
that is supposed to be. I mean, it's like, what were these morons? I have to say, these morons in charge of the country. What were they doing? What were they thinking?
Well,
Why were they so incompetent?
does anyone think that UK public services have improved over that period?
No. I mean, it's just extraordinary, Keith. I'm totally flabbergasted by, I remember, totally flabbergasted by the degree of incompetence.
Okay, so the red line is total departmental spending in the UK post the spring statement. Well, so this year's spring statement is expected to be. And the blue line is last year. So, the Labour government has massively increased our government spending over the lifetime of this parliament. But, from everything you read in the press, they are still struggling to balance the books. And we need the PSBR is out of control. And Rachel Reeves is on track to miss her fiscal rules. So something needs to give. She needs to either actually start cutting departmental spending instead of increasing it, or she needs to raise taxes quite substantially, or she needs to break her fiscal rules. None of those
I mean,
are.
the problem that she's got, I mean, this is her problem, it's not mine, is that their only realistic solution is to raise taxes, and because they're a Labour government, and in fact the Tory government did the same. Their only realistic solution was to raise taxes, and what that does is it just grinds the economy into the ground, and that's the route they're taking, and that's the route the Conservatives took as well. I mean, as you say,
Be
it just
fair,
makes my
Richard.
blood pressure even more.
I do agree with you, but to be fair, the UK economy has been remarkably resilient. I mean, I really expected the changes in NI to slow the economy, but you've seen from the PMIs that they're low, but it hasn't killed the economy. The economy does cope with higher taxes, but all the things they're doing to disincentivize employment, you are ending up with a lot of people, young people who can't get into the employment market. That's not good.
The problem is the economy is barely coping. I mean, we can barely, our defence expenditure is 3%. Is actually, Trump is right. The 3% our defence expenditure is too low to face the threats of the world. The care sector, the elderly care sector is falling apart. Our roads are falling apart. The NHS is simply unable to cope. And so raising taxes a little bit, it's like papering over the cracks, and the cracks are just going to continue to form unless we actually say, well, actually, if we want to provide this level of public service, then the economy needs to be more productive. We
That's
do want to
true.
provide this public service. Therefore, the fundamental issue we have to address is making the economy more productive. But what they're actually doing is they're doing the opposite. They're saying, we will take more out of the economy, which will make it less productive, in order to try and make the public services look like they're a little bit better. But constantly what's happening is public services are depreciating, getting worse. And so their solution is precisely the opposite to the one that
Well,
will actually solve the problem.
their solution is always statist, and as you say, to provide more social care. Now, talking about social care for the elderly, I mean, I find it astonishing that you pensioners get free social care when they've still got huge financial assets. That then they can pass on their house, etc., to their children while getting free state care. The private sector solution would be you pay for your own social care, and if
Yeah.
you've got any financial assets, they go to paying your
And
social
that
care.
piece comes back to your point about the gerontocracy having hijacked the political process,
Exactly.
not in a coordinated manner, but basically because they have votes. So ahead of the publication of the UK government's industrial strategy, UK electricity prices, we have to remember, are 50% higher than the EU average. But I hear Ed Miliband is on his bicycle 20 hours a day, generating 12 volts and 40 watts.
Yeah. If only we could
That is
keep it
about,
there.
that is the thing he is most useful for.
Yes.
So the UK CPI was overstated by 0.1%. I mean, I think that's just an error. As in, within the
Yeah.
area of measurement. I think the problem is, all of these things are they're so marginal. I mean, CPI is not marginal, CPI is important, but
It was a shocking number. It makes it
yeah,
a little less shocking,
yeah,
but still shocking.
yeah. So summary, not much economic data, a lot to be gloomy about.
Yes.
Watch our podcast if you wish to be depressed.
Yeah. Yeah.
Services PMI was uselessly higher at 50, no, cut that bit.
Yeah.
So very little economic data this week, and UK economy. I think it's proving resilient, but it's not really going anywhere. It's not, to my mind.
Yeah. Stagflation,
Not growing.
sadly.
Yeah.
Spring statement this week. Okay, thank you, Richard. On to the EU, and we will actually try and push through this. So, the ECB cut rates by 25 basis points, but Christine Lagarde warned that we were towards the end of this cutting cycle. Frankly, I don't believe her. I think she's going to keep on cutting because EU inflation came in weaker than expected at 0% in May and 1.9%, i.e. below target. Core CPI also faded down sharply to 2.3% from 2.7% in April. So that is very encouraging, well below expectations. And service inflation finally looks like it's heading back down. That's quite a sharp drop. PPI was negative again for the second month in a row. That's encouraging year on year, 0.7%, well below expectations. So, factory gate inflation low. GDP growth, however, was revised up to 0.6% quarter on quarter in Q1. That's actually decent. So that's 1.5% year on year. Employment change was revised down to 0.2% quarter on quarter, 0.7% year on year. But still growing, the unemployment rate remains at historic lows. Is the Eurozone finally starting to work? Services PMI was revised up, but still negative. So that suggests, if you look at the chart of the past year, the Eurozone economy steadily slowing, and this is before tariffs have really affected the European economy. Composite PMI was revised up to 50.2, i.e. just on the border between expansion and contraction. Construction PMI fell against an expectations rise, but it remains firmly below 50. Economic sentiment, these are the Eurostat surveys. Economic sentiment actually recovered slightly to 94.8, but that's still a poor number. Consumer confidence was at minus 15.2 on expectations, still not a great number. Inflation expectations, this will please the ECB. After rising steadily, they've started to fall again. Consumer inflation expectations, though, the ECB survey rising. So the Eurostat survey saying they're coming under control, ECB survey saying they're not. Industrial sentiment minus 10.3, recovering slightly. Selling price expectations, this is good news. Eurostat saying that manufacturers are not expecting to increase their prices by as much. That's great. Services sentiment, better than expected, still poor. Loans to companies, 2.6% year on year. That's better. Recovery in loan growth to both households here, 1.9%, and to companies, which means money supply growing at 1.9%. Perfectly respectable. Economic surprise index, resilient. Job postings, are they starting to flatten out? And in France, they do appear to have flattened out. So, as the jobs market in the EU, is that no longer deteriorating, suggesting that the economies are sort of stabilizing? So, in summary, ECB cut rates to 2.15%. Reminder, Donald Trump is still threatening to impose 50% tariffs on the EU. Very unpredictable. Certainly, there will be higher tariffs on the EU, and I think the EU will return to its sort of pre-pandemic structurally weakness, and I expect interest rates keep on falling. Right, on to the US, Richard.
Thank you, Keith. The US non-farm payrolls, 139,000 in May, pretty flat.
But April was revised down by 65, March by 30.
This is a very unstable data series because it has such huge revisions in it. Doge has succeeded in cutting US federal employment by 20,000 in April. Not huge impact. Monthly employment change by sector in the US shows that health and education services by far the biggest continuing employer, and construction sector also continuing to add jobs. Professional business services and manufacturing, retail all falling.
The continued strength of construction mystifies me because we're now seeing construction spending year on year falling.
And employment growth looks like it's slow, very, very spiky graph. This obviously it's a very, very long-term chart, but it's clearly employment growth is slowing.
Yeah.
And non-farm payrolls systematically revised down in later months, as we just alluded to, which makes the non-farm payroll information fairly useless for the contemporaneous non-farm payroll information, fairly useless, especially with revisions as large as they are. And household surveys reported a fall in employment of 700,000 month on month, which may well be true. Noticeably, the last non-farm payrolls was revised down by 100,000, which is the difference between those two numbers pretty much. So,
well,
still rising.
696,000 is a lot. There's a big fall.
Yes, sorry, ignore what I last said. Yeah, it is a big fall.
So once a year, non-farm payrolls are audited to the hard data in the form of the quarterly census of employment and wages. Reminder, most of non-farm payrolls is produced by a model of the US economy. And the latest data suggests that in 2024, private payrolls grew at only 0.6%, rather than the non-farm payrolls estimate of 1.2%, i.e., non-farm payrolls overestimated jobs growth by 0.6% or double the actual rate. And that implies 2024 non-farm payrolls were overstated by 907,000, i.e. almost a million, or an average of 76,000 a month. So in 2024, it looks like non-farm payrolls were way too high and jobs growth was much lower than reported.
US ADP employment change was 37,000 increase in May, which is worse than expected, significantly worse than expected.
That is not a good-looking trend, is it?
It's not. Wouldn't be surprised if next month goes negative.
And reminder, ADP, that's hard data, is not a model like the non-farm payrolls.
US challenger job cuts, nothing to see here, I would say. It's, apart from that spike in early 2025, which presumably was to do with Trump, basically sort of at the top end of the range from 2023, mid-2023, but nothing remarkable. US weekly earnings month on month up 0.4%, which is higher than expected and higher than April. And year on year, 4%. So there's data from Paychecks and ADP, payroll processors suggest that wage growth is actually slowing to around about 3%-ish. US average weekly hours worked, 34.3. So there's
not
still
great,
in that down, but no, still in that downtrend, but possibly coming out of it. US unemployment rate, 4.2%, stable. US participation rate, actually pretty steady at about 62.5, 60. It's not changing very much. GDP growth quarter on quarter annualized down 0.2%.
Yeah, as we discussed, this is an artifact of the huge surge in imports in Q1. The underlying economy was just fine.
And the AI boom has delivered this massive boost to the US economy of 1% of GDP, which is really significant.
Yeah, absolutely. How sustainable is that, we ask ourselves?
Consumer spending, real consumer spending, up 1.2% in the first quarter.
Yeah,
which is
suggesting a big slowdown, and this spooked the markets.
Yeah. And Goldman Sachs forecasting that US real consumer spending will continue to slow in 2025. Quarter on quarter, PCE prices annualized 3.6%.
Not good.
No.
Second quarter in a row of rising PCE prices.
Yeah, it's true. And quarter on quarter annualized 3.4%. Again, rising. Month on month, 0.1% in April, which is low.
Yeah, that's right.
And year on year, PCE 2.1%, which again is all right. So
yeah, that's good actually. Below expectation, looks good.
And core PCE month on month 0.1%, which is good. PCE core PCE year on year 2.5%, which is also good.
So looking at core PCE prices, services, ex-housing, is coming down. It's now at 3%, still too high. Housing, definitely just slowly coming down. And that means that PCE prices should, inflation should continue to fall in the coming months. But goods prices, which have been deflationary over the last year, are no longer deflationary.
So most businesses hike their prices due to tariffs, and many of them had a pass-through rate of 100%.
Yeah. So that's why tariffs are going to be inflationary.
Personal income month on month up 0.8% in April.
Yeah, US consumer doing great.
So US personal spending month on month in April up 0.2%.
Yeah, so income much higher than spending, increase in savings.
Services PMI in May 53.7, so that's looking quite healthy.
Yeah, big revision up.
Yeah. And composite PMI in May again 53, so that's also looking quite healthy. And the ISM services are down to just below 50. It's okay, but it's all bumping along the bottom.
Well, so they're going in opposite directions once again. You know, the S&P Global going up and revised up, the ISM services sharply falling. Now, as we've talked about many times previously, they are slightly different. So the ISM services includes anything that is not manufacturing. So I think it includes extractive industries like oil, and construction, whereas the S&P Global includes just service industries. So anyway,
ISM services new orders dropped dramatically in May. I mean, is this artifact of tariffs? Possibly, although there is quite a strong downtrend since the highs of 2022. And the ISM manufacturing PMI is 48.5, fairly on a very gentle upward trend there, but below 50. Jobs, job openings basically seems to have leveled off after that sort of fairly steep decline over the last 2 years. And the jobs quits, likewise seems to have leveled off after the decline. So maybe that suggests the job market is stabilizing. And the real-time job opening numbers is continuing to decline, which contradicts what the jobs is saying. Need a bit more data, really.
Yeah, but I think it implies that jolts, which is volatile, will continue to fall. And all that means that there's little change on the beverage curve. So the job opening rate is and the unemployment rate are pretty much unchanged. Now we're still expecting the falling job openings in the coming months to mean a rise in unemployment, but that will be bad for the fiscal balance.
So factory orders month on month, big drop in April after a big rise in March, probably a tariff artifact.
Yeah.
Distributive goods orders month on month, exactly the same, probably a tariff artifact. Logistics managers index looking quite healthy.
Yeah, that's surprising. I was expecting, the fall in goods imports to the US because of
Yeah,
tariffs would lead to fewer goods moving around the country, but doesn't seem to
not
be the
yet.
case.
Chicago PMI 40.5. I mean, mid 40s seems to be the new 50 for the Chicago PMI,
Yeah,
and
true.
it's in this sort of trend of not really going anywhere for the last couple of years. And the Chicago Business Barometer since 2000 is at the sort of bottom end of its range, but it's not falling out of bed yet. And the Conference Board Consumer Confidence Index is doing the opposite, really. It is still in a gentle downtrend. So construction month on month down for the second month in a row. The Case-Shiller House Price Index up 1.1% in March. There's two consecutive large increases. Year on year, though, it's 4.1%, which is down from February, below expectations and on a downtrend, slightly peculiar. The US goods trade balance, after what was obviously the people front running the tariffs, has now dropped to a more normal
Yeah,
negative performance.
but it hasn't dropped as much as I expected. I'd expected
No,
it's dropped
you're
right
right.
back.
Exactly. Yeah, it's interesting, isn't it? And the US trade balance, effectively the same effect.
Yeah.
It's
So this is really interesting that, the trade tariffs has not had the huge negative effect that, I was expecting.
it suggests that there's a lot of stocking that's
Yeah.
happened and that the rather than running down stocks, importers have continued to import, having stocked up.
Yeah.
So US exports looking very healthy, I have to say.
Yeah.
That chart is looking good. And US imports, clearly we've got that tariff spike. But relative to exports, that's also looking healthy if you ignore the tariff spike. Initial jobless claims, quite high, actually, like this week. And
Yeah.
suggesting that maybe there's a beginning of an uptrend. Continuing jobless claims also has been on the high side for the last few months, generally, and on the high side. So have we got a new trend, an uptrend forming? Jobs postings index, that still falling, but there's gradient of the curve flattening out. And Link Up is reporting rapidly declining job openings.
Yeah. It's been doing this for a few months, and there's a difference
Yeah.
between the monthly and the weekly, but still, definitely downtrend.
Yep. US, but so the Dallas Fed weekly GDP 1.9, 1.8. So it's basically pretty flat. And Atlanta now 3.8.
Yeah, I think the Atlanta now seems very affected by gold and flows,
Yeah.
etc., and is bouncing back from its big drop last quarter, I
Yeah.
think.
New York, a GDP now cost 2.3.
Yeah, this is the one I believe I like the
Yeah.
most. And
It's
so
also quite stable, this one, isn't it? It's
exactly. Yeah, so it's saying the US economy growth is slowing but remains decent.
and the St. Louis at 1.6. And so the US economic surprise index is negative this week, but as you know, I have
Moving
struggled with
swiftly
it.
on.
US trueflation, 1.9%.
Yeah, now we've been expecting inflation to keep rising in the US because of tariffs. And in May, that was certainly the case, but the rise seems to have stalled. Interesting. And truflation in the US seems much more accurate than the UK.
Yeah.
The
Thank you.
Brave Butler Kelly indices are an attempt to use online data, so millions of data points about the US to get a reading on how the US economy is doing. And what's interesting is that it turned negative in February and March, which does not indicate a recession, but it indicates that growth is slowing.
And the world has lost confidence in US financial assets. So the dollar index, as we discussed, has declined substantially, and the US 10-year yield is rising. So we've got a falling
Yeah.
dollar and a rising yield, which is unusual.
Yes.
And the latest regional Fed Beige Book is the most pessimistic it's been outside of a recession.
Yeah. Interesting.
Yeah. Business worried by tariffs and related uncertainty. So
Mm.
May 2025 is red, and there's a lot of unhappiness there. And US fiscal deficit is enormous, but it's not currently growing.
Yeah. Yeah. But I think
Remains
if
to be
Trump
seen.
gets his
Depends on
big,
the,
beautiful bill through, it will do.
yeah, precisely. And illegal immigration is collapsing. And is that bad for inflation?
Question mark. Yeah.
Yeah.
You know, lots of very cheap labor. The source of very cheap
Mm.
labor is disappearing. So, in summary, Richard, I think that data tends to show that the US economy is slowing, but slowing
I agree.
slowly, in particular, the non-farm payrolls. I mean,
Yeah, I agree, Keith. I think it is, for the first time, there's been a consistent trend in most of the data suggesting that it's slowing down,
yeah, we're not
I would
talking about
say.
recession. We're talking about growth slowing.
Yep, I agree.
Okay, thanks, Richard. Quickly on to China. So this morning early, we had CPI numbers for May, and they were weak. So China slipping back into deflation, not a sign of a healthy economy. Year on year, price falling 0.1%. PPI, factory gate inflation, minus 3.3%. Prices falling are not good for corporate profitability. Balance of trade, very healthy. 103 billion
Mm.
up on April, tariffs having no effect whatsoever on Chinese exports, which were 4.8% year on year in May, slightly down from April. Imports, though, weak, down 3.4% year on year. Not a sign of a healthy Chinese economy. Manufacturing, but the National Bureau of Statistics manufacturing PMI 49.5, up slightly. Services PMI down, but close to 50. With composite up slightly. Frankly, I've struggled to believe any of this. The private sector Caixin manufacturing PMI dropped sharply. That seems much more plausible, frankly. Services PMI was 51.1, which is low by historic standards. Composite was 49.6. So, according to the Caixin composite, Chinese economy not doing great. Now, what's interesting is that the credit impulse remains quite low. So China has not been attempting to stimulate the economy by increasing bank lending and, in the way that it did during COVID. So in summary, all the signs are that the Chinese economy is structurally weak, I would say. Inflation, weak, a PMIs, close to 50 if you believe them. And onto one chart. So this is in orange, US government debt as a percentage of GDP, and in yellow, US corporate debt, the debt to profit ratio, which is low. And you'll see corporate balance sheets in the US are fine. And what's allowed deleveraging in the corporate sector is re-leveraging of the government sector. Now, in order for US government debt to come down and US while maintaining US economic growth, you need the opposite to occur. US corporates to be re-leveraging while the government deleverages. And for that to happen, you need interest rates to come down. But as it is, there's no indication that the US is intent on deleveraging, frankly. They just keep on growing the debt.
But the other point there, Keith, is it's not realistic to think that one would substitute the other. But if the corporate debt were to substitute government debt, then corporate debt interest rates would have to go up massively, and the debt burden on corporates would be far too large. So, yeah. I mean, the only solution, in a world where all other things are equal, the only solution is a deep recession to reduce government debt is a deep recession.
Yeah, but the thing is, Richard, that won't work.
No, because not all other things are equal.
Yeah, that's right. Because you get a collapse in tax revenues unless you also cut spending more, which implies a deep drop in GDP. So what I was going to say is that the US is running a fiscal deficit of 6 or 7% and getting GDP growth of what, 2 and a bit? It's very inefficient. Okay, now this year we've had, last 3 years been totally wrong about government bonds. And we've talked about this continually, but just to reiterate, medium term bond yields should come back down once the bond markets have gained some reassurance, and this is an if, gain reassurance about the trajectory of government debt levels, because when you look at it long term, there is a negative relationship between debt to GDP levels and economic growth. So higher debt levels mean lower economic growth, because as your debt burden increases, you are diverting money from investment to paying the debt, and that is bad for growth. But that assumes that the deficit is under control and you're not just continually running a huge deficit. That's not true for Venezuela, for example. It's only true if the deficit and inflation are under control. And as there's a strong correlation between nominal GDP growth and interest rates, and as nominal GDP growth comes down after the post-pandemic surge, so bond yields should also come down, all else being equal. Of course, right now, all else is not equal because markets are worried about government solvency. And there you go. The relationship between nominal GDP growth and rates is a good one. So long term, I expect that relationship to hold. But obviously, I've been wrong in the last couple of years, expensively wrong. So once the bonds vigilantes have been appeased, expect yields to come down.
So let's have a quick look at Section 899 of the Big Beautiful Bill. So what it does is it gives the US Treasury the power to apply a tax surcharge of 5% up to a maximum of 20% on any country that it deems levies extraterritorial and discriminatory taxes, for example, the EU's digital services tax. So this would allow the US Treasury to tax foreign income on US assets under those circumstances. And it would be an easier and faster way to tax than to tax physical goods. So effectively what it does is it allows the US government to arbitrarily almost tax foreign investment in the US.
Yep.
And if that ability is there, then it obviously reduces the attractiveness of investing in the US because the potential return becomes much less certain, and there's a potential for effectively a 20% charge. Now, I don't know whether that would be an annual charge or a one-off charge, for
No, that
example.
would just be
Yeah.
ongoing. So, you just say, well, while this measure remains in place, we're going to take 20% off your interest or dividends.
Yeah. So it's bad for the US dollar, bad for the US bond yields, bad for funding the US fiscal deficit by external parties, bad for US equities, and particularly for non-US holders. So really, it creates a lot of implications for foreign investment in the US. And I think there's a lot of pressure being placed on Trump to change it. Doesn't
Yes.
necessarily mean he will. As we've seen, there's a quite significant movement out of US assets by foreign holders. Section 899 is likely to increase that movement out. Section 899 has only really become apparent or in the news in the last few days, as far as I'm aware. This is showing the S&P 500 relative to the FTSE All-World, excluding US. And what it's showing clearly is that the attractiveness of US markets has dropped substantially. And we've seen that, for example, in the rise of the European stock markets versus the US markets. So this may be the beginning of a period of underperformance by US investments, and obviously it remains to be seen what response we get to the protests about Section 899. But I guess the overall effect is a continuation of the damaging effect of the tariffs and tariff uncertainty, and that it's making the US a less and less stable trading and business partner.
Yeah.
Foreigners have huge holdings of US financial assets. Clearly, if they were to sell a large, significant proportion of those, then that's going to be damaging for the price of those US assets. So the US international investment position is a negative 25 trillion.
Yeah.
Which is pretty amazing. That's 25 trillion more invested in the US than the US has invested elsewhere.
Exactly. If those foreigners were to sell that, super bad for the dollar. You could see a cascading collapse of the dollar briefly.
That investment, that 25 trillion net investment in the US has been super good for the US economy.
Yes.
So obviously there's a speculation about how much this tax could see the dollar fall. Trump wants a weaker dollar, so he might be rubbing his hands with glee as he watches Beach Subran. Remains to be seen, doesn't it?
Well, the thing is, if they pass this bill, Trump would almost certainly use it, is what I'd say.
Oh, precisely, yeah. And does it? What about individuals who've got investment? If I happen to have shares in Apple, do I and use it? Do I then suffer the consequences of this?
I'm not sure, Richard. Don't know.
No. It's a significant question.
Yeah.
For private investors.
Yes, absolutely. Okay, so we've overrun this week. So last special section is on the Toboggan trade. Now, as you know, I've closed my position in long-dated gilts. So what have I been doing? Well, we talked about this a few weeks ago, that if you can play the yield curve to get very good tax-free gains. So this is TG46. It is the tax efficient, i.e. low coupon gilt, and it yields currently about 5.27%. And that has a just over a 20-year duration, so 21-year duration. The TG35 yields 4.67%, and that has a 10-year duration. So if you hold the 20-year for 10 years, if the yield curve remains stable, then the yield will fall from 5.27% to 4.67%, which implies a yield uplift. So over those 10 years, you will get better than 5.27%. So you're riding the yield curve down. Simon W. of our Discord has named this the toboggan trade. And I've done the maths on the toboggan trade. So current yield on TG46, 5.18%. Current yield on TG35, 4.6%. I won't go through the maths, but we've the spreadsheet is on the Discord. We have checked it, and the results are that if the yield curve remains stable, then if you held TG46 for 11 years, i.e. the yield on TG46 becomes the yield on TG35 in 11 years, then you would get 5.67% gross. So not 5.18, 5.67. So that's more than a 10% uplift in the yield. And that is because it's a low coupon bond. If you're 45% taxpayer, that is 44.95% net. And in order to get that 4.5%, net, you would need to get 9% in a bank. So if held outside your SIP, this is very attractive. 9% equivalent. And this is the pull to par. So this is how you expect the nominal, the price of TG46 to behave in the market. It steadily rise by about 3.4% per annum. That's your capital gain. And it's also possible to play the toboggan trade at the close end of the yield curve. So play for the TG35 10-year versus TG30, which is the 5-year. And in doing so, you take less risk, less duration risk. So the current yield on TG35, i.e. the 10-year, is 4.6. The 5-year is 4.05%. So holding TG35 for 5.5 years to get to TG30, assuming the yield curve remains stable, you would get an annual return of 5.27%. That's 4.89% net, or that's the equivalent of 8.9% in the bank. So pretty much the same yield as in the 20-year. And this is the pull to par, which is 3.8% per annum. So if you want to get good returns from tax-free returns, then the 10-year offers you almost exactly the same, but slightly lower returns from the toboggan trade as does the 20. And you can play it even closer with the 5-year versus the 2.5-year. So going through the maths again, holding TG30, the 5-year for 2.5 years, yields 4.3% gross, 4.14% net, or 7.5% equivalent. So yields, bond yields are attractive if you don't hold them to maturity, but you play the toboggan curve just falling down the yield curve. And actually, one last point. So just briefly, this week I had a dalliance with AI that I'd like to share with you all. So I was reading an absolutely dreadful book, but in it, it contained this poem that I'd never come across before. Again beguiled, again betrayed, in manhood as in youth, the slave of every passing maid that ever lied like truth, which I quite liked. I thought, where does that come from? So I typed it into Google. I just couldn't find it. So I thought, I know what I'll do. I'll put it into ChatGPT and get it to do the searching for me. So this is what ChatGPT came up with. It's from a fragment by Lord Tennyson, and you can click on the link and it comes up with the full poem, except it doesn't. This is total nonsense that it has invented. There is no poem called a fragment. Actually, there are many Tennyson poems called a fragment, but none of them is this. It has taken the first verse I gave it and nicked another verse from somewhere else and created a new poem. So then I thought, well, this is very interesting. Let me go through the top 6 AI search engines and see what they say. So this is DeepSeek. It invented a poem called Again by Walter Savage Landor. Notice how specific they are. This is Meta AI. It invented a poem by John Dryden. This is Poe. It invented a poem by John Keats called The Ballad of Sir John Franklin, which is actually a poem by someone called George Henry Boker and is about, you'll remember, the doomed British naval expedition to the Northwest Passage, which ended in starvation and cannibalism, and is unlikely to start Again Beguiled, Again Betrayed. Now, and I found this really interesting. Perplexity AI actually pointed correctly to Lord Byron and correctly to the document that contained the right poem. But again, it invented a poem called To a Lady on Being Asked to Write in Her Album, which does not exist, even though it referenced the correct PDF.
Extraordinary.
Yeah, so Claude
So how can
AI.
you trust?
So to finish, Rich, so Claude AI had the decency to say it couldn't find it, as did Gemini 2.5, and that is really useful. That's a really useful function. Just say I couldn't find it, rather than
Yeah.
saying, just inventing something. And the actual poem is titled Again Deceived, Again Betrayed. You'd think this is quite easy to find. And is actually by Lord Byron about his affair with a Welsh serving girl, Susan Vaughan, who had betrayed him with another lord, the mores of the time. So I'd be interested to see what you think, Richard. But I previously I've been saying, well, AI is going to lead to a productivity revolution. It's going to be great, etc. But actually, having used it, I'm thinking, well, what if it doesn't? What if it just fills a lot of documents with total nonsense and beguiles productive workers into putting a load of nonsense into their documents?
So I think that's really, really interesting, Keith, actually. Well done for doing that bit of original research. And it throws up a huge problem, doesn't it? So, because the definitive nature of an answer you get from these AIs, they are confident, they're clear, they're detailed, they explain specifically, they're factual. And so if you don't know the answer, how do you differentiate between the truth and the not true? And the answer is you can't, which makes them extremely dangerous.
Yes.
Now, the second point is that what AI developers are talking of doing, and probably are doing, is using AI to train AI, which means that you will get a gradual but exponential, in this case, you get a gradual but exponential drift away from reality into a disreality created, a factual disreality created by AI as it trains itself, and which renders AI not only totally useless, but actually completely dangerous. And so what I would say is this is general AI, isn't it? As in, a large language model. If you use AI trained on specific data for specific functions and constrain it within that data and that function, then I think you probably don't come across this issue so much because its boundaries are very clear. And it should very clearly state, I don't know the answer. But with this, with this large language model that looks across all of human information that it can find, There's no way of controlling it. What do you think, Keith?
Well, I think it's dangerous. I think you're absolutely right that I think if you constrain, you've got a good data set, you've constrained it on, it seems to give good answers. And clearly, Claude AI and Gemini 2.5, I think they must have some checking to see whether their answer actually exists. And that is very useful.
Yeah,
I wouldn't trust the others,
yeah.
frankly. So we're massively overrun, I'm afraid, as usual, because we got carried away chatting. We next time will be in 2 weeks' time, and we will try and restrain ourselves and do lots of the other sections I've been meaning to do for ages. But concluding comments. So markets have calmed down, and VIX is back at complacency levels, but the macroeconomic and policy uncertainty continues. When we go through the news, I mean, the tariffs, they just change every other day. And so when the CBO is trying to calculate what the effect of the big, beautiful bill will be on the US fiscal debt, it's very difficult. It's impossible to know because it depends on Donald Trump's whims. But I think what's really interesting this week is that the labor market data coming out of the US clearly shows the labor market is slowing and all the nowcasts are coming down. Not quickly, but they are coming down. So the US economy is slowing. Any
Yeah.
further comments, Richard?
No, I agree with you, Keith.
So thank you all for watching. Hope to see you again in 2 weeks' time. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.